Hey guys, Dominique here from Domino Effects Group, and today we're going to do something a little bit different. I have not done this before, so just bear with me. It is my first one, but I get asked a lot of questions, so I'm basically going to just start shooting out some answers to those because if one person's asking, I mean, there's got to be more people who are thinking the same thing. So, one question that I get is when is the best time for me to get financing for my business? So, let's dive in. Is a short-term loan the best financing option for your business, right? So remember this, a short-term loan is going to be paid off a lot quicker than a traditional term loan. The shortened pay structure is going to have some repercussions. So it's going to be good, it can be bad, but let's start looking at some of the benefits. So there are perks, a lot of perks to short-term funding, and the first one is going to be speed. Right. So our lenders that we work with, they don't have to abide by some of the same strict regulations like the bank. So the process is a lot faster because there's less paperwork. So everything's done online, completely digital. You can get the application done in less than 2 minutes. It's streamlined, it's fast, it's quick. So we're able to actually get the funds to you within the same week, depending on the amount, or the next day, or even the same day, even in just a few hours. So it's also easy to qualify. So as I said before, how the banks have like stricter requirements, let me give you an example. So here's a strict requirement that a traditional bank will have, that they require a business to have been in operation for 2 years or longer, that they have a credit score that's above a 700 and can offer up some type of personal or business collateral. So that would be something like if you're offering up your personal collateral, you would be offering up your home, maybe, possibly, or collateral for business collateral. That would be something like inventory, or maybe if you own a transportation company, one of your vehicles. So alternative lenders, we have less strict requirements. Then you got to think about the cost of capital is lower. So our short-term interest rates are higher than traditional term loans, but the accumulation of interest is for a much shorter period. So in the end, the cost can generally be much lower. So alternative lenders we can offer capital to a much wider selection of business owners as well. Banks don't tend to lend to companies that, as I mentioned, have been operating less than 2 years, or startups, or if they're producing less than 10 million in revenue, or if they're one of those industries that they consider high risk, like maybe manufacturing or retail, right? Because they go through dips in revenue. So just every short-term lender's got revenue requirements. They've all got different requirements, not necessarily revenue requirements, but they're all different. So if you can meet our minimum requirements, then you can qualify for some type of funding, and that's 6 months in business, if you're making $5,000 a month in revenue at least for the past 3 months, when you have at least a 450 credit score. So that's just one option, though, that we work with at Domino Effects Group. We have other options as well. But for every advantage, there's a disadvantage, right? So what's one of the disadvantages of a short-term loan is you're gonna look at potentially higher interest rates. So I get asked this a lot: why are shorter-term loans have higher interest rates? Well, first, it's easier for businesses to qualify for a short-term loan because of those less strict requirements that it takes. So, from a lender's perspective, there's a higher risk of default. So those increased interest rates and those fees ensure to the lender that their investment is going to be profitable. And then the second point to why short-term loans have higher interest rates and fees is you're really paying for the speed. So when you go to a bank and you take out a loan, it can take a few weeks, sometimes months, to go through that process. So we speed up that process. It takes less time with our alternative lenders to vet a business, which also means more risk for the lender. So it's just their way of protecting themselves. So another disadvantage would be more frequent payments, because short-term loans are riskier for the lender. So you're going to make more frequent payments. That's just the way it is. But depending on your profile, and they can work with you usually on a weekly versus a monthly basis, but it depends. There are also lenders that we work with who ask for daily payments. So it could be daily, weekly, or monthly. And this comes down to really making sure that your cash flow statement, that you really took a look at your day to day and your cash flow. It's important that you crunch your numbers so that you know and you can determine how much your budget can actually handle. So, last, you're going to be looking at higher payments. Sometimes it can be a little shocking to hear how high the payments are, along with the frequency. And if you have not done your due diligence and really planned out what you're going to use the loan for and actually use the loan for those purposes, it can be very problematic. So it's very, very important that you stay prepared and ahead. Evaluate and compare your lender offers. One, you really need to consider the offer. So it can be really tempting to pick the offer with maybe you're getting the most favorable APR, which is your annual percentage rate. But if you're going to lock in a smaller loan than you actually need, even if you're getting a lower rate, that's not really going to help you cover the cost of your cash flow gap, right? Especially if that's the purpose of you getting the loan. If the purpose of you getting the loan is to cover a cash flow gap because you are in an industry where you experience that dip, right? Like, let's say you own a Christmas lighting store, right? You're probably, most of your business is going to come during the holiday season, right? So by taking on the smaller than what you need, you're not going to help cover that gap. So this can also go for, in considering the offer, if you're asking for a $20,000 and you get a much larger offer than you asked for, if you don't really need it, then probably don't accept. But again, that's up to your discretion. I'm not a financial advisor. So second, you're going to want to consider the loan repayment term. So a short-term loan is typically going to mature in 18 to 24 months or less. Long-term loans typically have repayment periods of 5 years, maybe 10 years, 7 years. So you need to know what time frame is going to work best for your business, and also how it's going to work for the specific investment that you're going to be using the loan for. So what is it going to work for what you're going to use the capital for? And then last, you want to consider if your business is even in a position to repay the loan. So if the payments are going to dramatically shrink your cash flow, you're going to really need to consider that. So are you going to be comfortable working with a smaller margin during those payoff terms? And so these are all things to think about. Make sure that you're comparing loan terms so that you can decide what option is best for you. At Domino Effects Group, we want to help empower you with services that are going to help you grow and stay sustainable. Maybe you don't meet those revenue requirements. That's okay. Our goal is to really put you in the best possible position to receive funding from lenders when you're ready. And we do this by empowering you with services that are going to help you grow and stay sustainable. So book a consultation with Domino Effects Group today. It's free, and let us help you fund your dreams.